£66,362. That's how much tax we've just saved an agency that their previous accountant completely missed. My name's Rayhan, I'm a chartered accountant and the founder of Psychic Accounting. Over the last 5 years, I've transformed how agencies handle their finances. We now handle millions in agency revenue, and in this video, I'm going to show you some of the strategies we use to help them make more and keep more. With HMRC's new crackdown and regulations in 2025, your agency can't afford to get tax wrong. The next few minutes of this video can end up saving you more money than all of the tax saving tips that you've seen combined. Now here's a picture most agencies scaling to 7 figures and beyond will find familiar. You hit those revenue milestones, 50k a month, 100k a month, 150k a month, and suddenly you get hit with a massive tax bill that you didn't see coming, and it drains you of all of your cash. Here's what's happening in the agency world right now. You're growing revenue, you're hiring team, you're building out the infrastructure you need to be a 7 or 8 figure agency. But what you're not doing is managing the finances and cash flow to be able to support that growth confidently. Combine that with a current depressed economy in the UK, and your client's marketing budget's drying up, your business has very little headroom for shocks, such as a surprise tax bill. Most accountants will tell you how much cash to put aside and save for taxes. But what they won't tell you is how you proactively work to reduce that amount in the first place. They're simply doing your compliance, they're not looking at strategy. And for agency today, that's simply not enough. You need to work proactively to reduce the amount of tax that's going to leave your business. Now, when it comes to tax strategy, agencies have unique financial patterns and trends and a business model that opens itself up for various tax planning opportunities. Now, your local general accountant is treating your agency the same as they would a corner shop or a taxi driver or the pub down the road isn't going to be aware of the opportunities that lie there for you and your agency. Before I jump into the specific strategies you can use to reduce your tax bill, let's talk about the difference between tax avoidance and tax evasion. There's an important distinction to make when you're looking at tax planning opportunities. The first is it tax avoidance or is it tax evasion? One is legal and one is completely illegal and will land you in prison. So tax evasion is where you're deliberately trying to not pay tax by hiding income, for example, or reporting fraudulent figures. This is the one that will land you in prison. Tax avoidance is understanding HMRC's rules and applying them to your situation in a beneficial way. It's legal and it's how you end up paying less tax. A great example of this is R&D tax relief. The example I gave at the beginning of this video of £66,000 saved came from an R&D claim that our client had based on things they'd already spent money on that their previous accountant just hadn't picked up as qualifying for research and development. We were able to claim that because we understand the type of work agencies do, what would be considered legitimate for R&D purposes, and we are also able to produce the reporting and documentation required to submit to HMRC to get a claim approved and paid into your bank account. Next up, let's look at the 3 most common tax traps agency owners fall into. First up is the growth trap. In the UK, you have a marginal rate of corporation tax. That means as you grow your profits, you'll be paying a higher percentage of tax on that amount. What most agencies don't realize is that they've crossed that threshold and therefore they are due to pay a higher percentage of tax later in the year. So they're not putting aside enough money to cover that tax bill and they're getting caught off guard. That tax percentage varies from 19% for profits up to £50,000 and it's then on a sliding scale up to £250,000 where it hits 25%. If you don't understand how much profit you expect to make in the future, how do you know what percentage of money to put aside for taxes? Now, if you're worried about how much tax you're going to end up paying, I've got a tool that I can share with you. We've just updated our agency financial planning template for 2025. It helps you forecast exactly what you expect your profit to be for the year and therefore helps you plan effectively in advance. I'll tell you how you can get it for free at the end of this video. That brings us on to the second trap, which is the structure trap. This is where a lot of fast-growing agencies tend to trip up because they've set up a limited company and call it a day. That's leaving money on the table and leaving you open to paying too much tax. What you need to consider next is how you pay yourself as a business owner and specifically an agency owner. So what is the optimal balance of a salary and a dividend typically for you? Second is other means of extracting profit from that company. So you might want to take more than £50,000 a year out, which is not efficient to do through salary and dividends. Therefore, you want to consider things like company cars, pension contributions, and other tax-efficient ways of investing and using that money that mean you're not paying higher rates of income tax. We're seeing agency owners pay over 60% in tax through their company and their personal tax position unnecessarily. If things are planned effectively, you could be paying just 19% corporation tax and using the rest of that money tax efficiently to invest, to fund your lifestyle, and to build wealth. These aren't small savings. Often we're talking about tens of thousands of pounds of tax overpaid each year. Now here's a quick question for you if you're watching this video. What's your biggest challenge when it comes to the tax structure within your agency? Drop it in the comments below and I'll personally respond with some insights. And finally, the third trap agency owners tend to fall into is the timing trap. And this isn't about filing your accounts on time. It's about choosing when to pay yourself, when to make certain investments, and how you structure your taxes around your natural business cycle. Get this wrong and you'll have penalties coming at you all year round. Not just that, but you're also creating cash flow problems for yourself that are a bottleneck to growth. Now remember the agency financial planning template I mentioned. There's a link in the description. If you click that, you'll be able to download this template completely free, and it's the exact same template that we use to help our clients avoid these tax traps. Now here's a bonus for you. Knowing the tax traps is great, but let's look at how you can strategically plan to avoid them. Again, these are the exact same principles we use with our clients day in, day out that saves 6 figures plus in tax every single year. First, you need a proactive tax planning framework. That's an ongoing strategy that evolves with your agency throughout the year. Here's what it looks like in practice. Firstly, you want to have monthly financial reviews to understand what's gone through the business, what is tax deductible, and if you've crossed any major thresholds that mean new opportunities are available to you. The second is the strategic timing of making investments and also paying yourself so that you're not awkwardly between tax years or utilizing allowances one way or another inefficiently. Third is regular forecasting to avoid any nasty surprises. If you always know what you plan to achieve for the year ahead based on the current things that are going on in the business, you'll be able to proactively plan and put money aside for taxes and other liabilities that might arise. And finally, having clear visibility of the tax threshold. So when you're looking at where you expect to land, make sure you understand where you land within the thresholds and therefore how much tax you might be due to pay. Second, you need the right systems in place. For us and our clients, that means having the right reporting available to you every single month, looking at your tax position throughout the year alongside a professional, having proper documentation in place to back up any claims that you're making, so if HMRC came knocking, you wouldn't be asked to repay that money to them, and regular forecasting and a tax dashboard that shows you the latest position in terms of how much tax you might expect to pay in the future. Now, if you found this video useful, please click like because it helps YouTube share it wider to other agency owners who can also benefit. And if you know any other agency owners, please feel free to share this video with them so that they can get access to our planning template, but also to avoid these common tax traps. So here are the 3 key takeaways for you off the back of this video. Number 1 is to review your current tax structure. Is it still fit for purpose based on where you are in terms of revenue and profitability? Second is check where you land on that threshold of tax and make sure you understand what percentage of tax you're going to end up paying. And third is to make sure you have good records so that when you do make a claim such as R&D, you're able to back it up and you're able to get paid out. Now, if you're planning for growth in your agency in 2025, you can't afford to sleep on these strategies. And if you want a partner that can implement all of them for you end to end, that's what we do at Sidekick. We help agency owners like you make more money and pay less tax. So if you want to know where you might be leaving money on the table, book a call with a member of the team using the link in the description for a free chat about where your agency is and where you want to take it. As always, please like and subscribe if you found this video useful.